Howdy, Jacob here. Today we are looking at Occidental Petroleum Corporation, the infamous company that's owned by quite a few great investors. When I looked at Dataroma, we have Warren Buffett, we have Lee Lu. Um, we just have some of the most well-known investors investing in Occidental Petroleum. I haven't read through their quarterly reports or 10K yet, but I have watched multiple videos with Warren Buffett talking about him and his praise of the current CEO, saying that she knows what she's doing. And it's funny that he doesn't. When I hear him talk about the business, it's not like he fully understands it, but he definitely understands the concept of oil and how important natural gas is in general, um, and just has a massive trust, like I said, for the CEO. And so today we're going to be reviewing the financials of the business and putting in uh, some financial projections to see where I would do a deeper dive into this business. And the first thing I see is that their enterprise value is quite a bit higher than their market cap. So they are looking at quite a bit of debt here. It looks like they operate through three segments: oil and gas, chemical, midstream, and marketing. Founded in 1920, headquartered in Houston, Texas. Their revenue growth is crazy up and down. You have as low as negative 35% and then as high as 45%. So it's a very cyclical business, very likely depends heavily on the price of oil. But even with that, margins are almost consistently positive. Looks like there's two times in the last 10 years where they did not produce a positive operating margin. But when prices of oil are high, they get massive margins because it's really just cost of goods sold is majority of their costs here. They do pay a dividend. It seems to be a reasonable amount compared to their earnings per share, and return on invested capital really all over the place because their earnings are all over the place, and that's the numerator of return on invested capital. As we saw, majority of costs are going to be cost of goods sold with very low SG&A, low other operating expenses, and really just net interest from the amount of debt that they have. So the balance sheet does show $2 million cash on hand with 2 billion cash on hand with 1 billion short-term debt, 24 billion long-term debt. So they have leveraged their growth a little bit, but it is down quite significantly from 5 years ago or so. Their cash from operations shows very immense capital expenditures, so it does take a lot to keep the doors open, keep business flowing, but they have 1 year in the last 10 that produced negative free cash flow. Majority of their cash is going to made some big acquisitions here. I want to say the Persian Basin or whatever it is, um, which kind of is like a royalty business almost, kind of the way I would think about it. And dividends, they pay quite a bit for the dividends. They bought back shares 2022, 2023. Um, let's see, that might have been a pretty advantageous time for them. So 2022, 2023, I guess it was higher than it is today. Not necessarily saying it's overpriced, but if they bought it, when it was single digits, that could have been an immense return for them, which we're not necessarily seeing. But anyways, I think we're ready to get to our own assumptions here. So for revenue growth, they do have a lot of debt here. I think they're going to be spending a lot of capital allocation on debt reduction in the near term. Their dividend is pretty inconsequential to their free cash flow. Have they increased that? Okay, that's kind of all over the place, but we'll increase that 3% a year or so with revenue growth, maybe 5%. Because, they'll definitely grow with inflation, I think, but then also I think their ability to acquire businesses And what I've heard of that CEO, she's going to do fantastic things for Occidental. I think 5% seems pretty reasonable. They do have quite a bit of debt, and it is quite substantial in relation to their free cash flow. So about 24 billion, and their free cash flow is about less than five. So it is over 5 years their free cash flow. So maybe I'll put them at a 14 price to earnings, price to free cash flow. It is more cyclical. Companies that are more consistent, I think, get higher praise in the market, and so because of its inconsistency and enterprise value, I think I'm just damping it a little bit. For share change, we did not see stock-based compensation. They do issue some shares here, but I'm going to say it's relatively flat with margins kind of all over the place. I love that free cash flow is quite a bit higher, but maybe let's say like 15 and 20%. I think that range is pretty large, but still, I still think is very reasonable. So with these current assumptions, we're saying the price needs to fall 21% before you get the return we're looking for here. So, I mean, I think it's a great business. I do think it's a business I don't know super well, and so I would definitely have to do a good amount of research before investing in it. From my knowledge, it just kind of will likely move with the price of oil. Um, but with everything I've heard of the CEO being as great as she is, and all the top investors loving the business, this would definitely be a company that I would love to do some more research on. And so we're pretty close to a price point that makes sense from initial financial analysis. So I'd definitely love to do a deeper dive shortly and kind of see if I see what those big investors are seeing or not. But either way, I hope you enjoy this video. Um, I hope you do your own research. I think this will be a definitely an interesting company, and hope you have a great rest of your day. Thank you.